This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel. A long week ahead because there's so much central bank action across the globe. But today looks like it's going to be a good start. I mean, the SGX Nifty is a bright shade of green. And the global cues are not too bad either.
They're not bad, but will we have a repeat of yesterday, right? Yesterday also we had that 70-point uptick on the SGX. By open, it sort of shrank quite a bit. But we have solid positive cues this morning. And I'm going to start with something which came out in terms of data yesterday evening, which is the consumer price inflation numbers. We've seen a sharp disinflation in the India CPI, May CPI. Two RBI meetings, prior, that is before the April RBI policy, inflation was 6.5%. We're at 4.25%, April to May. That is the kind of disinflation we've seen. And I think this number, while this is in line with expectations, this kind of bodes well for the RBI to turn decisively dovish in August. Not rate cuts, but many were expecting a change in stance in the RBI meeting which just happened. Maybe we'll see that in August. Of course, all of this depends on how monsoon rains pan out and what that does to food prices, etc. But this is, I think, in terms of just handoff from data yesterday, unambiguously positive. Overnight, the cues are decent. The Nasdaq ended up about 1.5% higher. The S&P was up about 0.9%. There is a sharp 4% fall in oil prices as well. And I think this is important to highlight. And it's quite stunning, right? Saudi Arabia, for example, at that last OPEC meeting, cut output unexpectedly, but prices have not budged. If anything, they've actually gone down, gone south, and tells you what the market is kind of focused on, which is anticipating that perhaps growth is not going to be strong. Now, in terms of further cues, and I think the next 2 days are going to be important, will affect how much risk-taking people want to indulge in. The US CPI number is later today, and then you've got the FOMC meeting tomorrow. The Fed decision we will react to on Thursday morning, and that's why I'm saying that, this is going to be a little tricky. I think in the US, markets are there's no volatility. There's no fear. And there is no fear that there will be volatility around this CPI number. More and more people are getting convinced that maybe we will see a pause and perhaps the peak of rate hikes are behind us in the US. So that's the positioning. So if you're trading very near term, you need to be cognizant of this, that markets are not prepared for any large volatility based on what the Fed chair, etc. may say. So I think one needs to keep that in mind. Now, yesterday, the Nifty bounced off an important level, which is Friday's low. Friday's low and yesterday's low are almost exactly same. Mid-caps and small-caps did well. The Nifty was up 0.25%, but the small-cap index was up 0.9%. The mid-cap index about 0.5% or so. So there's no problem there. It kind of just picked off from where we left off last Wednesday. Thursday and Friday, of course, we had seen some pullbacks. So Friday's low becomes important. 18,555 is that number. On the way down, that is. We are just 50 points away from that. And then there is the 20-day moving average, which is 18,453. Another 50 points. Another 100 points below Friday's low. So these are support levels to watch out for. On the way up, Thursday's high becomes important, which is the level to take out for further upsides to materialize. That number is 18,788. Bank Nifty yesterday closed marginally below the 20-day moving average. It's been around that level for the last several days. And yesterday we got a close which is 40-50 points under. But it's not a materially large close which decisively changes the trend. So I would want to watch this perhaps one day more and see what the market wants to tell us. So the Bank Nifty 20-day is at 43,980. But I think the 40-day exponential moving average, if the 20-day breaks, and we get one more close below the 20-day, the 40-day exponential moving average at 43,352 comes into focus, which, by the way, again, is not very far away. It's about 500, 600 points away. Resistance level for the Nifty Bank comes in at 44,499. It's a level which the Bank Nifty has hesitated to cross, has not crossed for several days to come. SGX is indicating a positive start. You got the handoff from US, you got the CPI numbers, all positive. But I would still say if you're trading, given the event risks over the next couple of days, and the loss of momentum. There is a clear loss of momentum in the Nifty, in the large cap space. I mean, you hold off, watch like you did yesterday for the first 1 hour or so, and then decide if you want to buy that dip. I mean, you do get a dip and then you get a bounce. Maybe you play that, but don't chase the open right at the outside, right at the open. Sonia.
Oh, absolutely. I mean, the SGX Nifty for now is indicating a positive start, but there are big global events upon us. The US FOMC, there is the Bank of Japan meeting, the ECB meeting as well. You don't know which way things could go. But you know, the global markets were very strong, the US market specifically. And one thing I noticed is that the dominance of big tech is back. So whether you look at Apple hit all-time high yesterday in terms of stock price. You also had the market cap of Apple has now exceeded $3 trillion, the valuation of Apple. So that's, you know, one big move over there. Tesla is up for the 12th straight session. Oracle was up about 4%. So in that context, big tech is back, and perhaps it could extend into our markets. You never know. We've seen a comeback, especially in some of the mid-cap IT stocks. So that's one pocket to look at. Apart from that, you have, of course, expectations of a pause by the Fed. So everyone's looking forward to that. Nikkei has hit fresh 2023 highs as well. So across the globe, you know, this morning Hang Seng is under a bit of pressure, but the Japanese market has been doing very well. In our own markets, there's been very strong buying from domestic institutions, second straight day of four-digit buying there. In fact, in just 2 trading sessions, we've seen in excess of 3,000 crores come into the Indian markets from the domestic fraternity, although FIs continue to sell. And of course, the macros continue to improve. So retail inflation has dipped to a 25-month low. But is all of this enough for the Nifty to move out of the resistance zone? No, I'm not too sure about that, because this 18,600, 18,650 level has been a bit of a sticky zone for the market. This morning, the SGX Nifty is indicating that we'll sort of make an attempt to get there and get past it. But let's see how the second half of the trading session goes. But sectorally, my eye is now in the IT space after what we're seeing transpire in the global markets, especially in the US.
Well, you know, Sonia, the headline index may wait to see what the Fed will do. But the mid-cap and small-cap indices, they are saying you could wait for the headline index. We are going ahead.
Yeah.
You know, that's been the theme for the last few days. Even yesterday's trading session, the mid and the small-cap indices, well, they did very, very well in trade yesterday. Now, lower crude prices, this morning crude price is down 3% overnight. And in the last 1 week, it's down by close to around 10%. That's a positive. The low inflation print is what we have gotten as well. The big question is, can the Nifty Bank find its form? That's going to be important, because the last couple of sessions, you know, from the RBI governor's speech itself, it's corrected close to around 800 points approximately. So is it done with this, its lull? The 43,700, well, that's the lowest level we've seen in the last 11 sessions. So can we see a bounce on the Nifty Bank? And importantly, today is the Nifty Financial Services Index expiry, since it's a Tuesday, so we'll see some bit of volatility pick up out there. A quick word on the institutional data. The institutions were net biased because the DIs, they are pumping in the big money. But the FI participation actually is quite much lower. If you look at the FI participation yesterday and compare it with what we have seen in June prior to yesterday, well, the volumes, the gross volumes are 25% lower. It seems they are in wait and watch mode. So you'll get a better trend coming from the FIs, I think, post the FOMC meet. Yesterday they sold mildly, but the participation itself was much lower. What do the FIs do in the FNO market? Well, they covered some short positioning. Now the shorts are at around 51%. They bought more calls than puts, so that's a little bit of a bullish sign. But what's more bullish is that they wrote more puts than calls. You like to see that. 2 strikes were active yesterday, 18,600 put. Well, that had a fair bit of open interest build up. There was writing being seen out there, premium at around 50 rupees. And the calls that were written earlier, there was some unwinding that we saw there, 18,700. With the kind of move that you've seen, with the kind of cues you've seen, I think the call writers got a little bit jittery in yesterday's trading session, which brings us to the levels. If the 20 DMA holds out, well, everything is okay. You'll have to maintain a long position out there, though resistance comes in closer to around that 18,800 odd mark. And since it's a Nifty Financial Services Index expiry, there was writing being seen at around that 19,450, 19,500 puts. There was actually a fair bit of action that we saw there. Resistance comes in at around that 19,480, because the 19,450 call was very active. So that resistance level is very, very important. And support as well comes in at around 19,350. The final hour or so belongs to the Nifty Financial Services Index. Let's see whether or not it's enough for the Nifty Bank to perform today. If the Nifty Bank performs, then it'll be good news. Don't chase the opening. That's the call that we made yesterday as well. Don't chase the opening. If you get an intraday dip, maybe you could look to buy into 20 DMA becomes the crucial support level.
All right. Well, so SGX indicating, like yesterday, a higher start, but no point getting right in. You wait the texture of the screen and then decide what you want to do. Well, before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Matt Orton of Raymond James Investment LLC will join us to discuss that. Later, our research team gets you the top 10 stocks of the day, and we'll have Harendra Kumar of Elara Securities join in to talk about what he's seeing in the market, his top ideas, top bets. Stay tuned.
All right, we also have a couple of equity views coming in this morning, so let's get straight to it. First up, we have Surendra Goyal of Citi, who says that mid-caps have had a strong 2023 and the outperformance is coinciding with strong momentum in FI inflows in this quarter so far. If history is any guide, a sustained bull rally in equities could lead to more outperformance in the near term. He adds earnings growth in mid-caps is somewhat lagging large caps and could be the key to sustenance as valuation premiums now, both PE and price to book, are above long-term averages. Overall, on the Indian equities, Citi's Nifty March 2024 target indicates just a 4% upside from here. Okay. So I guess range bound is the way to go.
Absolutely. Well, Pankaj Chachor of Antique Stock Broking also comes in. He says that markets may consolidate in the near term given premium valuations. Recent macro data from the US, which has led to a sharp upward revision in terms of Fed rate outlook for CY23, that is calendar this year, and expectations of another rate hike in June or the July policy. The third reason he thinks why markets may consolidate is a likely recession in the US in the second half of this year. Overall, given expectations of a capex cycle recovery, they remain constructive from a one-year perspective and prefer industrials, real estate and banks. Antiques March 2024 Nifty target stands at 20,500.
Okay, let's also try and get you some money market views this morning. A lot has happened there. Abhishek Goenka of IFA Global says this is a week of key central bank rate decisions. He says the US Fed was expected to pause, but recent Reserve Bank of Australia and Bank of Canada's surprise hikes have enlivened the Fed meeting. He says if the Fed too delivers a surprise 25 basis points hike, we could see the dollar strengthen. He does not, however, see exaggerated moves and expects the RBI to continue to keep the dollar INR under a tight leash. He also expects the dollar INR pair to trade in a range of 81.60 to 82.90 over the next few weeks.
On bonds, we have Ajay Magnolia weighing in. He's, of course, with JM Financial. He says that fears of further rate hikes among bond traders has subsided a lot post RBI's pause last week and the cooling CPI inflation for the month of May. However, he adds the FOMC decision this week has been creating volatility. He says the sense prevailing amongst most investors is that the RBI might stay its course of maintaining stability in rates and liquidity with a long pause as far as inflation print stays within its comfort zone. He expects the 10-year benchmark bond yield to stay in a range of between 7 to 7.05% for the day.
Well, we have a lot of stock-specific action. We'll get to that in just a bit. But for the time being, let's run you through our top 10 list that we're tracking. We're looking at JSW Steel, Canfin Homes, EIL, SJVN, Inox Wind, and Inox Wind Energy. They are stocks that will be reacting to positive news flow. While on the flip side, we have Hero MotoCorp, Z Entertainment, ONGC, and Oil India that will be reacting to negative news flow.
Okay, well, so that's views and what's lined up here in terms of stocks in just a bit. But Matt Orton is now joining us. He's Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here. Thank you very much, as always, for your time. Prashant this side. Matt, so we get into one more FOMC, and this one is close once again. So which way are you leaning? Is it going to be a pause, or there are those like, for example, I think the global economists at Citi who are expecting a hike in June as well? What's your sense?
Hey, good morning, Prashant. Always good to see you. My sense is that we're going to get a pause. Like you said, it's going to be close. I think there's going to be some division within the voting members, but I expect we're going to get a pause, and then it's going to be a hawkish pause. So I think what's going to be most important later on today or tomorrow for the U.S. markets is, or Wednesday, sorry, is really going to be what Powell says. We get the CPI data tomorrow. I'm not sure how much of an impact it's going to have either way, unless it's much, much hotter than expected. Then I think a hike comes back into play. But base case is a hawkish pause. Listen to what Powell has to say, because I think he's going to continue to guide and emphasize that this cycle is not necessarily done. They are still going to be data dependent. Inflation has been sticky, and we've seen a lot of volatility with respect to the economic data. So as I've been saying, really, all throughout this year is that we need to take the Fed at their word. When they say they might not be done, they really might not be done. And I think the main message for investors is that higher for longer really means higher for longer, and a pause does not mean a pivot. So again, I've been enthusiastic. It's great to see the rally. I think we've gotten some of that right, but overall, this is a time to still lean into higher quality companies because globally, the economy is in fact slowing down. You want to own earning stability. You want to own profitability, free cash flow companies. And breadth is definitely a challenge in the US market in particular. And those higher quality companies that may have lagged the AI rush in technology, that's what will work if breadth improves. And it's also what's going to work in case you see a little bit of consolidation.
Okay, so you're expecting a hawkish pause from the Fed and you're saying lean into quality companies, but it's been a spectacular ride, right? I mean, the NASDAQ is up almost 30% this year, and now big tech has come back in a big way, whether it's Apple, Oracle, Tesla. What do you do about that pocket and in general about equities? Do you see more upsides to global equities, especially the US, irrespective of which way the Fed goes?
I think it is going to depend on which way or how hawkishly the market interprets the Fed. Because at the end of the day, a lot of the mega cap names that have driven almost all of the gains for the US equity market this year, a lot of them are higher quality companies. You can't deny that Apple and Microsoft and Alphabet that are throwing off $100+ billion of free cash flow along with improving earnings momentum. You can't say those aren't quality companies. They definitely are. But I spent the past week traveling and talking to clients, and my biggest message to them is risk manage your position sizing, because it's perfectly okay to still own those companies going forward because there are long-term secular growth drivers to them. You want to have them in a portfolio, but take some chips off the table, take a lot of the gains that you've had, and think about redeploying that back into other parts of the market, because those higher quality parts of the market, they've done okay, but they haven't kept up with tech. And again, if you do see consolidation in the market, those are the names that are going to hold up the best, and that's what I want to own. And again, if the gains are going to be sustained for the market, breadth has to increase, where we're sitting at historic levels of narrowness for the US equity market. And if we're going to see sustainability to this bull market, we have to see more sectors, we have to see more stocks participate in that. And again, that comes back to those companies that have missed out a little bit. So it's all about asset allocation, and I think that's what's going to be the winning trade at the end of the day.
All right. Hi, Matt. Good morning. Nigel on this side. Matt, I wanted to ask you about this hawkish pause that you're talking about. So you mean they paused this time and they could return to hiking? You're clearly not factoring in any rate cuts, at least in this year.
No, Nigel, I think, as I've said a lot, whenever we've met, and what I've said consistently this year is that I do not expect the Fed to be cutting this year. I think the only scenario in which the Fed cuts rates this year is going to be really, really bad for the overall market and economy. You have to see a precipitous decline in economic activity in order to get the Fed to start cutting rates. And I just don't see that in the cards. That the data has been pretty benign. I mean, you've had some good data, you've had some bad data, but nothing's been that bad that would signal a pause. And nothing's really been so fantastic that you can't say growth is going to slow down. But it's been good enough. And for me, that presents opportunities in the overall market, but do not expect a cut.
Actually, there are three central banks which paused, right? There was Australia, there was Canada, there was Norway. And guess what? All three have started hiking again. So, but I mean, smaller banks and smaller decisions as compared to what the Fed has got in front of it. But point taken, Matt. Great to speak with you. It's always a pleasure. And thanks very much for being here on CNBC TV18. Well, we'll take a quick commercial break here. Our top stocks to watch lined up next in just a bit. We are back with our research team.
Welcome back. My entire research team is standing by with CNBC TV18's list of top 10 stocks that you can watch out for as we begin the day's trade. Well, there is more uncertainty in store for Z investors following the SEBI order that has come through. Surbi is here with more details on that. Surbi, over to you.
That's right. So now SEBI has barred Subhash Chandra and Puneet Goenka to hold any key managerial positions in any listed companies. Now this order comes after the fact that regulator has found Subhash Chandra and Puneet Goenka both have siphoned off funds from Z for their own benefits. Now they have 21 days to file their reply or objections regarding this order. Now this will mean delayed timelines on the merger process, which were expected to move faster after NCLAT had dismissed the NCLT appeal, which was to reassess the exchange approval. Now, Puneet Goenka is slated to be the MD or the CEO of the merged company, so we will wait to see what happens there. And also, the next NCLT hearing is on 16th June, so we will await more details post that hearing also.
Okay, thanks a lot for that. So we're going to, of course, keep in mind that Z Entertainment could be under pressure today. Bad news coming through once again. So more on that in a bit. But before that, we also have some news on Hero MotoCorp. So we'll keep that on our radar this morning. There was an investor day that Hero MotoCorp had held, and here are the key takeaways. They have some aggressive launch plans in the premium segment, in which they have an under 10% market share currently. They have 4 new launches lined up in the premium segment, and they're looking to set up 100+ exclusive premium outlets. So that's one area that their focus is on. The second area they're focusing on is electric vehicles. They plan to launch EVs in 100+ cities by FY24, and 2 new EV scooters will be launched in the mid and mass segment by FY24. They've identified 3 levers of growth. One of them is expanding the core segment. Second is growing the premium segment, as I pointed out. And third is looking to become a leader in the EV segment through both distribution as well as through partnerships. CLSA has put out a note where they've actually downgraded the stock to a sell. They retain their target price of 27.08, which is below the current market price. They say that although the plans that Hero MotoCorp have are very aggressive, there is a lot of competitive intensity at the moment in the sector, and the market share gains are something that will remain a challenge for the company. So I'm going with red on the back of the downgrade.
All right, that's Hero MotoCorp. We'll see how the stock opens and discuss this and put this to Harendra as well in just a bit from now. But more stocks with news flow. Vivek is standing by with that list. Vivek, hi, morning.
Well, good morning. Quite a few stocks on the radar on the back of news flow. Engineers India Limited, some positive news flow coming in. The company has got an order of 472 crore from ONGC, and the project completion schedule is around 40 months for this particular order that the company has won. Keep an eye out for LJVN. The renewable energy arm of the company, that is LJVN Green Energy, has got a 200 megawatt wind power project order via the EPC contract route. The competitively bid price for this particular order was 3.24 rupees per unit, and the cost of construction of this particular project stands at around 1400 crore. Watch out for both the Inox Wind as well as Inox Wind Energy. The group has gone in for a simplification as far as the cross-holding is concerned. So Inox Wind will now be merged with Inox Wind Energy. And when you're talking about the merger ratio, 158 shares of Inox Wind will be issued for 10 shares of Inox Wind Energy. Along with that, 158 share warrants, which has an issue price of 54 rupees each, will now be issued for 10 share warrants of Inox Wind Energy at an issue price of 847.
Okay, all right. Thanks a lot for that, Vivek. Well, let's go back to Surbi. She's got some more stocks that she's tracking for us. Surbi?
Yeah, so on my radar is JSW Steel. Now they have declared as a preferred bidder in the auctions for granting mining lease for iron ore mineral in Goa. Now the projected iron ore resources in these 2 blocks is 75.5 million metric tons. The next one on my radar is Canfin Homes. There is a board meeting on June 19th to consider a fundraise via equity or debt. Back to you.
Thanks a lot, Surbi, for that. So a lot of stocks in focus. But crude, there was a big move in crude overnight. Manisha joins in to give us the latest on that. Manisha, 4% fall is what we saw.
Oh, absolutely. 4.5% of a decline in the overnight markets for the crude prices, and that brings us to a 5-week lows for the crude prices. It is now down 6% on week as well. There have been concerns about weak demand in China, and even as Saudi Arabia has cut output by 1 million barrels, it is Russia, Nigeria, UAE, Iran, where output really seems to be increasing. And then we are looking at rising Russia crude to India, China at record levels as well. The derivative markets also have seen extended selling. We also have seen fresh shorts stocks being created in case of crude oil prices. So perhaps the downside is not done yet from here. Also, there is an increase in the U.S. production. So if you are looking at higher production, higher inventories, but demand not so strong. And then you have data watch as well. The U.S. inflation numbers come in today and the U.S. Fed meeting tomorrow. So ahead of that, the participation also is lowered. Most of the investors on the sidelines. If there are any seen to be selling, there could be some more pressure continuing here.
Okay, all right, Manisha, thanks a lot for that. Well, here's a quick recap of all the stocks we just covered for you. Stocks with positive news flow include JSW Steel, Canfin Homes, EIL, SJVN, Inox Wind and Inox Wind Energy. While stocks reacting to negative news flow could include Hero MotoCorp, Zenatainment, ONGC and Oil India.
All right, the other positive news flow that we're getting this morning has come through from the retail inflation side. India's CPI for May came in at 4.25%, lower than what the CNBC-TV18 poll was, while the industrial output for April came in at 4.2%, way above estimates. Always good to see that. Lata is here to analyze the data for us. Lata, morning.
Yeah, it's a great combo. Growth better than expected and inflation lower than feared. The CPI number at 4.25, CNBC-TV18 poll was 4.35. The individual numbers, food is down to 2.9 from 3.8 in April. And more importantly, core CPI has not inched up but down a bit at 5.1 versus 5.2 in the previous month. But my point is that we should not read this as a reason why RBI may cut. For one thing, RBI's nowcast is excellent. They usually know this number before they went into the June 8th policy. And the one single message in the June 8th policy is we are nowhere near a cut. Every time we were asked that question, we were told that we want 4% and our own forecast is 5.2 for the last quarter. So it looked like they are not looking for a rate cut this calendar or even this fiscal. That was the mood. But let's come to the growth number. IIP number at 4.2 versus our poll of 1.3. And it's an impressive set of constituents. You know, manufacturing, which is 77% of IIP, is up 4.9%. That includes metals, non-metallic industries, machinery, transport equipment. All these components were each up in double digits year on year. Outside of manufacturing, infrastructure was up 12.8%, capital goods 6.2%, consumer non-durables 10.7%. So it's an impressive across-the-board growth that we are seeing in industrial output. As if all this was not enough, the March industrial output, which was a sulk, has been revised upwards from 1.1 to 1.7. So my point would be this data is stocks positive. It is not bonds positive. The message is loud and clear. Growth is strong.
All right. But this IIP, the series itself is very volatile, right?
No, I agree with you that the components can be questioned a lot. But IIP has not usually lied about the direction. Okay. I mean, you may get very upset with the components, whether they're sometimes seriously, it's a joke sometimes. But the overall direction, if it is growth, it shows growth.
All right. Directionally positive. Absolutely. Point taken, Lata. Thanks very much for that. Well, let's take a very quick break here. Harendra Kumar is Managing Director at Elara Securities. He joins in for some conversation on markets, themes he likes and things that he's betting on. Stay tuned. We also will be speaking with the management at Titagarh Rail, erstwhile Titagarh Wagons. We'll discuss their fundraising plans via a preferential issue to a fund. Stay tuned for that conversation as well.
Welcome back to Bazaar Morning Call. We begin a brand new day and there are so many cues to discuss, so we'll get to that very quickly. But before that, GQG Partners continues to be bullish on the Adani Group. The chairman, Rajiv Jain, has downplayed all the governance concerns and says that they will buy more stake in the conglomerate over time. Listen in.
We don't have any target or anything. It depends on how the fundamentals evolve. But yes, I've already said that we are interested in increasing our stake over time. We do feel, in fact, the numbers subsequent to a purchase, as the earnings numbers come through, they've been fantastic across the board. It hasn't gotten as much press, but the numbers have been from ports to enterprises across the board, massive beats. So yeah, we quite like how well they're positioned on a longer term basis. So yeah, we are likely to add, but it'll be. I mean, we don't have specific targets, dollar targets, because it depends on so many things. No, we are not at 10%. Actually, more. We are between 3 to under 5% across all of them individually. So it's actually, yeah, it was the increase was 10% from the original amount. But yeah, we are sort of low to mid single digits, but under 5%, because obviously there'll be disclosure once you cross 5. But we have not crossed 5 for any individual company.
Okay, all right. That's about the Adani Group, but a lot more stocks to discuss. So let's get in Harindra Kumar, MD at Elara Securities, who joins us on the show. Hi, Harindra. Good morning. Thanks so much for joining in. Well, let's focus on Z, because that could be one of the top stocks in the first few hours of trade. News that came overnight is SEBI has barred a couple of their top executives, including Mr. Puneet Goenka, which as of the merger, details of what was put out was that he'll continue at the helm. How do you approach the stock? It's likely to pull back today. Do you think they will appeal to SAT, things will get sorted out, they'll find an alternative, and ultimately the merger goes through? So in that case, you look to buy into it? Or do you think, let's wait for clarity and only then get it?
Okay, I think beyond the event per se, I think let's take a step back and see fundamentally why would anybody want to buy Z? I think people were looking at Z is obviously subsequent to the potential merger with Sony. There'll be a lot of synergistic benefits that will flow into the company, and they'll be able to synergize, cut cost, add profit. That's one. And second is, of course, there was significant value in the stock given at the market cap that it's trading at with respect to the historical numbers. So these are the primary drivers. Now in this, towards this end goal, the NCLT clearances, the approvals from various regulatory bodies, where the intermediate steps to that end outcome, all right? And what the market is currently seeing is a lot of hiccups towards that end outcome. So now the bets are whether such an outcome, or that merger will play up successfully or not. So if you ask me, you're an investor who's a value trader and is eventually has time on his side and believes that over the next 3 years, these are very short-term hiccups and everything will be hunky-dory, then obviously every dip will become a good opportunity to buy into, right? But if you believe that you're a tactical trader, I don't think this is the time to enter. So I think that's the way you need to trade. With respect to the order, I'm sure, and it's all in the code. So there will be an appeal, and there will be a sufficient defense to every order that will come, and rightly so. So that's how we'll trade. But I think beyond this, especially in the media space, if you're looking to trade, if you think that FMCG, which has got the margin tailwinds on its side, is going to bump up its marketing and advertising, then a short tactical trade to that extent will be Sun TV. Mind you, I use the word short tactical trade. So over the next 3 to 6 months. So if you're not actually looking to trade Z, I think there are alternatives available within the space for the similar opportunity.
Okay, so but for Z particularly, do you think all of this could impact the merger? I mean, in terms of either a timeline or the execution of the merger?
So I'm not sure at this given point of time because these are all moving variables, and to pinpoint and say that this will work in your favor, I think it's a difficult statement to make at this given point of time.
Okay, all right. Yes, there are a lot of imponderables, especially with the news flow changing by the hour for Z and Sony. Got that. All right. Wanted to move forward and talk a little bit about the auto stocks, because there's been a big rally over there. But this morning, CLSA has actually downgraded Hero MotoCorp, saying that a lot of the good news is in the price, and there's a lot of competitive intensity as well now with a slew of new launches even in the EV space. What do you do if you own auto names, especially the two-wheelers?
Oh, actually, we are fantastic. We are very bullish on the auto space. I think over the next 3 to 6 months, the auto space will outperform some of the other sectoral indices. I think it comes with 4 or 5 large tailwinds. One is the softening of raw materials. Second is that the interest rate tailwinds is yet to creep into the consumer buying, right? And there is an imminent rural recovery which is under play. These are large structural tick points, which makes us absolutely optimistic about the auto space. Now, within that as well, you have the CV cycle, where people are expecting that it's topped out. In fact, we believe that there's a multi-year sectoral CV cycle that is under play, given that the fleet operators will go through a replacement cycle. So we are not worried on the auto pack. In fact, we are overweighting the auto pack. And within that, of course, you should have the PV plus CVs as your first pecking order, and then you could go to two-wheelers. In two-wheelers, I think Hero is demonstrating significant gains and retail sales at the given point of time. Valuation is also in its favor. So I think there are more legs to this rally at this given point of time. And yet I would say premature selling would work adversely in the favor of the investor, against the investor.
All right, Harinder, I request you to please stay with us for a bit. We're just inviting our first corporate on the show. Titagar Rail Systems, that's the first one. The company will raise close to around 288 crores, while the preferential allotment at around 380 rupees. That's a bit of a discount in comparison to the current stock price. To discuss more developments, what's it going to do with this money, we're joined by Mr. Umesh Chaudhary, the Vice Chairman and MD at Titagar Rail Systems. Hi, Mr. Chaudhary. Good morning. Thanks so much for joining in. Well, a couple of questions. One, you get some last good participation that's coming into this preferential issue. But why have you done it at such a sharp discount? Is it formula-based? And what do you do with this money that you have raised?
Yeah, very good morning. Thank you for having me on your show. So this pricing was based on the SEBI formula. The SEBI formula, which is for preferential issues, gave a price of about 245 rupees as has been declared in our exchange filing. And the pricing was being discussed with the investor for some time, and we cannot change the goalpost. The market keeps on moving up or down, but the goalposts have to be kind of fixed in such deals. And particularly, because it's a very marquee investor. So, we were very keen to have a good marquee investor. Of course, there are other very good marquee investors, but this just happened, and we thought it would be correct for considering our overall growth plans, our overall order book, which is above 27,000 crores. So obviously the ramp up that we require will require capex, would require investment. So to have somebody like Capital come in with us could have really helped us or given us that extra boost to be able to achieve the targets or the opportunities that the government of India offers in their infrastructure boost.
This is Capital International, right, sir?
That's right. It's okay. the Capital Group.
Okay, all right. So that's as marquee as they come. And why not, right? I mean, the stock's done very well, so maybe monetize that a little bit. What will you do with the funds, though, Mr. Chaudhary?
So as we had shared earlier, that we have a total capex of approximately 1,000 crore, including what we have done over the last 3 to 4 years, which is about 300-350 crores. So that's another about 600-650 crores that we have to invest, including our equity into the wheel project that we have won along with Ramakrishna Forging. So this fund would essentially go into the capex spending, some general corporate purposes. So it's, the whole funding that we are doing for this capex is by way of this equity, internal accruals, etc. So this is kind of a overall part of the overall scheme for funding our expansions.
Right. Could you tell us what is the how much capex is on the line right now, and this will take care of how much? Just some numbers.
So the total, as I said, the total capex that we had to put, including our equity, was into the wheel project would be about 650 crores. This would roughly take care of about 45%, 50% of that. And we are generating cash. If you see our March results, we did an EBITDA of almost 100 crores or 100 crores exactly. So, we would be generating cash. So between the two, the equity raise and this, and maybe if we need, then we'll take on some debt, but we don't think that we should require much of debt. So with this, we'll be able to complete our capex. Most of our capex should be implemented within the next couple of years, because with the orders that we have, with the pipeline of and the visibility that we have, we will have to kind of expedite the capex in order to be able to convert this order book into revenue.
Absolutely, got that. Umesh, hi, this is Sonia here. Thanks for being with us on the show. In fact, since you're talking about the orders, right, I just wanted to take that discussion forward. The last time you said that you have about 27,000 crores worth of orders, including what you have in the consortium. Where are we now in terms of orders? And in the next 1 year, what's the kind of order visibility that you're looking at, that you can execute and that will flow through into your revenue stream?
So, Sonia, the orders keep on getting executed and some orders keep on coming. Of course, when there is a large order, then we will come back to the market to announce. But, we would not kind of change the order book or give the updated order book on a mid-semester or a trimester basis. But in terms of the visibility that we have, we've already seen the Vande Metro project being announced by the government. The 200 new Vande Bharats that we saw in the newspaper reports that will be coming up. There are several metros. We just saw the Delhi metro expansion being cleared by the cabinet. So there are adequate and more opportunities in the sector. Fortunately, there's a lot of tailwind. And we are just trying to make sure that, we are there in the center of the tailwind to be able to get the speed.
Outstanding orders, are you L1 in at the moment?
Once again, we would like to comment on them once they get finalized. Nothing outside what we've already announced to the markets.
Okay, all right. Final question then before we let you go. What's the execution target for this year? Last year you did revenues, I think, of around 2,800 crores. I think you're guiding for margins in the vicinity of around 8 to around 10%. What's the execution though? Revenues, and give us a margin outlook for FY24.
So the margin outlook remains the same. 8 to 10% is what our industry has as a sustainable margin, and we would be able to continue to do that. As far as revenue targets are concerned, we do not give a future kind of guidance, but if you look at the run rate that we've already reached, so last quarter we did 976 crores of revenue. So we've already scaled up the run rate from where we started. So we were at 300 crore on an annualized basis 4 or 5 years ago. So we are at 1,000 crore on a quarterly basis now. So obviously we are continuously thriving to ramp it up. We are doing about 700 wagons now, which we will be increasing to 1,000 wagons by the end of this year. So definitely, all this money that is coming in and all the orders that are there and the pipeline of the tenders that should be there, and with this whole thrust on infrastructure, on Gati Shakti and all of that, we believe that there is a good runway ahead of us.
So 1,000 crores
this equity raising is also, this equity raising is actually going to help us to achieve that.
1,000 crores per quarter is doable, sir, right?
Already done that. We've already done that. So we've already
start
done
upping
that
it from
in
here.
March.
So, all right.
We
so
will
we'll
try to at least maintain that.
We'll wait by for an official number, but at least 4,000 crores appears pretty much gettable since you've done 970 crores in the past quarter, 1,000 crores per quarter, at least 4,000 crores. Maybe the next time we chat, you'll give us a more concrete revenue guidance, but things are looking up. Thanks so much, Umesh, for joining in and filling us in with your capex plans, the fundraise, as well as your execution for this year. Time to slip into a short break. On the other side, Anuj will be joining in to give us his market setup. We'll also be joined by our technical analysts as well. Will be joining in to give us their trades.
Okay, welcome back. Just 12 minutes to go for the pre-open session. Anuj is here in the studios with what he's making of things. Anuj, hi, morning.
Morning, Prashant, Sonia, Nigel. Well, let me stick my neck out today. I think we are in for a 200-point Nifty rally today. I mean, if it happens, doesn't happen, so be it. The cues are in place. There's a lot of macro cheer. There's been a lot of short covering without price moving up, options data. I think everything points to a really good Tuesday today. Of course, CPI and IIP data both looking quite good. The market had a bit of a sense of it in the last half an hour with the kind of rally that in NBFC, but still, the market's corrected from top. It's got some space going ahead. Going forward, you have the Fed decision and US inflation, which is also likely to be quite comforting. The liquidity is also likely to improve from here on with the advanced tax deadline getting over. And the global cues are very strong. Brent crude down to 72. I think it's only the HDFC twins which has sort of kept a bit of a lid on the market. Otherwise, this market is looking really strong and sensing all-time highs. The broader markets, of course, have already done that and looking quite strong. In terms of Nifty and Bank Nifty levels to watch out for, on the Nifty, the first resistance is 18,675 to 18,700 based on options. And the bigger resistance is 18,740 to 18,800, which is the previous swing high, which I believe could be tested today. Support, of course, lies in at 18,550 to 18,600. And then the 20-day exponential moving average, which is placed at 18,450. On the Bank Nifty, which again defended the 20-day exponential moving average in close yesterday, my sense is today that's going to lead. It's underperformed for last 3-4 days, but it's ready for a big explosive move. The low is around the 20-day exponential moving average, but my sense is that, perhaps a move towards even 44,500 could open up if you have a gap up and if that gap up sustains. So let's see if by the end of the day the neck is safe or not.
Okay. We won't just let you go with your safe neck. I mean, put some value to it, right? So if there's a 200-point rally, then is a lunch on you tomorrow?
Then the lunch should be on you. I mean, if it's not, then it should be on me.
It's you.
Prashant, we are gaining anyways.
Lunch on everyone. If the market rallies, it benefits everyone, right? All right. Thanks a lot, Anuj, for that. Well, Harendra Kumar of Elara Securities is still with us. So let's get a view going from him. Harendra, in the last fortnight, actually last couple of months, there is a return of a lot of the platform stocks, right? Whether the platform companies, whether it's Zomato or even delivery, Nykaa has come back a tad bit, Paytm as well. Do you have any stake here? I mean, do you like these stocks? And from an investor standpoint, is it good to go for more?
Yeah, so I think it's not a secular bucket because some of the names are demonstrating that they could achieve EBITDA break-even or PAT break-even over the nearer future. So to that extent, I think there is some confidence in probably Nykaa, Paytm, and possibly Zomato. All right, but there is a set of other companies like delivery, etc., where the profitability road is still with trouble and is going to take longer. So we would not treat the bucket as one secular bucket because valuations are still calibrating to the earnings trajectory of these companies. But some of them, yes, are demonstrating that in the near vicinity over the next 3 years, EBITDA break-even plus some significant growth in PAT is possible. And at that moment, they start to add value. So mind you, the investors who came in during the IPO are sitting on big losses. So they could look to add positions at this level to cut, to average their prices. But at the IPO levels, they will hit a lot of supply, given that the waiting period has happened and, they need to recalibrate their position. So at best, these trades will be from the current levels to the IPO position, if one wants to trade them tactically. So that's our view, at least over the medium term on this name. And after you cross the IPO levels, you'll see, how the growth for the next 4-5 years will pan out. But at the moment, it's a short trade for, the distance that we just spoke of.
Harendra, hi, morning. You guys do some very interesting work and deep dives, etc. What is your team most excited about, thematically speaking, in terms of what will make money from here?
I think number one is obviously the multi-year capex cycle. You just had Titagar Wagons on the show here. I think railways, though the budget has increased significantly, it's gone into a multi-year cycle. So that's one theme. It's early in the cycle now. So you have infrastructure, you have cap goods, you have power names. So there's a whole suite of names. For example, SJVN is adding 3x of its capacity over the next 7 years. Trades are on book or sub-book. With regulated, return equity of 13%. Same as with NHPC, NTPC. significant value on the renewable subsidiaries. So I think the value capture cycle for these names is yet to begin. You will also see a lot of old infrastructure names coming back. Order books are bloated. Typically, when that happens, you have a long earning cycle that comes off. Balance sheets repair itself. So that's a decadal trade. Currently, these stocks are still under-owned, so we like them.
Arendra, sorry to interrupt.
Analysis.
Sorry to interrupt. The entire IEX thing, which has happened over the last 3-4 days, does it raise question marks about these sort of regulated return entities and what may happen? I mean, does it cloud the skies a little bit in that sense, or no?
Yeah, interesting point. I think currently the market is facing a lot of, you can say regulatory assault from various kinds of companies that is adding volatility to the stocks. So we've analyzed IEX. We think that it's a storm in the teacup. We should wait it out, and I think the long-term trajectory for the stock is pretty reasonable at this given point of time. So I think especially for IEX over the long term, I reiterate, is pretty okay. Similarly because we're discussing regulatory outcomes, even for the mutual fund industry, my guess is that the trajectory of the sector is very robust. You will double AUMs in the next 4 years. So the asset managers and wealth managers are available at a significant discount to their intrinsic value here. So currently they will be hemorrhaged because of the regulatory overhang at this given point of time. But these are large structural plays. I think these are opportunities for value investors to deep dive at the moment.
All right, Harendra, just stay on. We'll come back in a bit. We have about a couple of minutes before the pre-opening rates kick in. Mitesh Thakkar and Sudarshan Sukhani are joining us now to give us their view. Gentlemen, morning to both of you. Sudarshan, let me start with you. How are you feeling about the market? We were just having a chat with Anuj where, he expects the market to see a big 200-point rally today. Are you as optimistic? And what should the, the trading sort of strategy be for the day?
Yeah, good morning, Sonia. I've been talking about buying every dip, every intraday dip. So clearly for me, the market has already been in an uptrend, and that has proved itself. Every dip bought would have made money. Now the same view applies today. The markets were in a narrow range yesterday. That narrow range is expected to break on the upside. When the market goes from contraction into expansion, it usually gives us a decent move, usually. I have no way of saying what the number of points would be, but my trade remains the same. Avoid the bank nifty. For the nifty, buy at the open, or if you already have a position, keep it or buy on dips. Stay long in the nifty, don't ignore it. Your stops are 18,400, and till then, be on the long side.
Okay, stay on the long side, 18,400. Remember, the 18,450 is the mark of the 20-day MA, so that's Sudarshan's call. Mitesh, what about you? Are you in the camp as well that will look to buy the nifty today?
Morning, Nigel. We've not been trading the index, purely because of the fact that the volatility indicators for the indices have turned nearly flat, and I think we're not very sure if we'll get a breakout immediately or it'll be more of consolidation. So we've been trading with long bias definitely, but more on the stock side. Having said that, the index, if it starts getting past 18,650 for the day, which could be with the opening gap, I think then we'll look at a target around 18,775, 18,800 to begin with, and beyond that, of course, we are looking at fresh highs, which should do very well. So broadly trading with long bias, but on the index, maybe after the opening, we'll take a trade.
Let's do one thing. Let's take a quick break. We'll be back with lots more on the market, on individual stocks as well. Don't go anywhere.